Welcome to the essential guide on the letter of credit, the vital engine that powers global trade. Can a simple stack of papers truly be worth more than a ship full of physical goods in the eyes of a bank? Let's find out. In international trade, buyers fear paying for goods that never arrive, and sellers fear shipping without guaranteed payment. This lack of trust is the core problem. The letter of credit, or LC, demystifies this process, providing a reliable means of payment for sellers and assurance of delivery for buyers. We will explore the key players, the fundamental principles, the step-by-step issuance process, payment timings, and document compliance. Our first core theme is understanding what an LC is and the primary parties involved in the transaction. At its core, a letter of credit is an irrevocable undertaking by an issuing bank to pay a specified amount to a beneficiary upon receipt of a complying presentation. The key players are the applicant or buyer, the beneficiary or seller, advising bank, and the issuing bank, which makes the binding promise to pay. For instance, if Fashion Forward Inc. buys from Style Exports, their issuing bank's promise replaces the buyer's credit risk with the bank's own financial strength. Next, we cover the golden rule of trade finance, the independence principle, also known as the autonomy principle. This principle states that banks deal exclusively with documents, not with the physical goods. They are paper experts, not product experts. If the documents presented by the seller precisely match the LC requirements, the bank must pay, regardless of any disputes over the quality of the goods themselves. In one example, if an LC requires a certificate but doesn't prohibit adverse comments, the bank must pay, even if the document states the goods are unfit for consumption, because the document exists. The process of issuing an LC has a methodical journey, starting long before the bank gets involved. The LC process begins with a detailed sales contract or proforma invoice agreed upon by the buyer and the seller. The buyer submits an application to their bank, and the issuing bank creates the credit, typically using the standardized electronic format SWIFT MT700. Any ambiguity in the buyer's instructions, such as failing to specify precise data for a bill of lading, puts the risk squarely on the buyer. Understanding when the seller gets paid requires knowing the LC's availability and its tenor. Site payment means the seller is paid immediately upon document presentation, while deferred payment means the bank promises to pay on a future determinable date, like 90 days after shipment. The tenor allows the buyer time to sell the goods and use those proceeds to reimburse the issuing bank. Other methods include acceptance, which uses a formal demand for payment called a draft, and negotiation, where a bank advances funds to the seller early. The choice of payment method directly impacts the seller's cash flow and the buyer's required financing arrangements. Our final core theme addresses how banks ensure the paperwork is perfect and what happens when mistakes are found. For the seller to get paid, they must make a, quote, complying presentation, meaning the documents strictly follow all LC terms, applicable Rule UCP 600, and international standard banking practice. For example, if the LC requires an invoice for tubes, but the seller presents one for pipes, the bank can reject the entire presentation due to this discrepancy. Banks have a maximum of 5 banking days to examine documents. If a discrepancy is found, they may refuse payment. Crucially, if the bank fails to notify the seller of these discrepancies within the 5-day window, they are legally precluded from citing them later and must pay the seller. The letter of credit is truly the lifeblood of international trade, building trust on the foundation of bank-guaranteed paperwork. It provides a robust, structured framework for transactions across the globe. Remember the key takeaways. Banks deal only in documents, issuance requires extreme precision, and strict adherence to compliance is essential. With the rise of digital trade, how do you think the transition from physical paper to electronic records will change business risk management in the next decade? Let us know in the comments below. Thank you for joining us for this guide. If you found this helpful, please like the video and subscribe for more insights into global trade and trade documentation.